since the crisis, and quite rightly so. However, I'm going to change the emphasis very slightly in my talk by talking not about economic theory per se, but instead about its application. So in particular, what I'd like to talk about is the application of macroeconomic theory by a monetary authority in the pursuit of monetary policy. In fact, the central research question, if you like, that I'm going to address in this talk can be stated quite simply, and it is the following. Can modern monetary policy work even if the policy model on which it's based is actually misspecified? And let me be clear, what I mean by modern monetary policy is an attempt to manipulate interest rates using some sort of reaction function that is sensitive to differences between macroeconomic variables and stated target values. And by policy working, I mean, can it stabilize the economy? More specifically still, can it guide the economy towards an equilibrium consistent with the stated target values of variables? So, can policy work even if the policy model is misspecified? And the answer I'm going to provide is yes, it actually can, at least in some circumstances. Now, before we all get carried away here and think, great, this seems to be then an excuse for policy model complacency, right? I mean, who cares if the model is wrong, as long as the policy works? It seems that there must be all sorts of latitude for getting policy right, even if the underlying model is wrong. So who cares about the model? In fact, I'm going to argue exactly the opposite. That, in fact, the purpose of this presentation is not to encourage policy model complacency, but in fact to warn against it. What I'm going to suggest is that policy model complacency, if it arises, okay, thinking that having policy work means that you have the correct view of how the economy works, actually exposes the policymaker to surprises, by which I mean events that can actually be considered as systematic events arising from what we might call the true model of the economy, that aren't, of course, foreseen by the policymaker because of policy model misspecification, but that can have, of course, severe negative consequences for the economy. And what I'm going to suggest is effectively to ensure against those nasty surprises, the best thing that a policy authority can do is to be always eclectic in its views about how the economy works. So that even if there is no appetite for replacing one policy model with another, which, you know, there may well be, in light of recent events, a very good argument for doing just that, even if that appetite doesn't exist, there's certainly a case to be made for paying attention to the great variety of essentially heterodox macroeconomic models that work in systematically different ways from mainstream models, make systematically different predictions, because one can ultimately regard those models as a free insurance policy against the downside risks of policy model misspecification. So that is, in a nutshell, the argument I'm going to try and make. Here's how I'm going to try to make it. The argument is really based on a simplified, one-sector, aggregate structural version of a familiar model, the three-equation new consensus model. So I'll just very briefly introduce that. Everybody, I'm sure, is already familiar with it. Time permitting, I will then give two specific examples of how policy can work even with a misspecified policy model. One involving a misspecified IS curve, the other involving a misspecified Phillips curve. Then I'm going to talk about the perils of policy model complacency, which is going to bring us really to the nub of the talk, and then finally some conclusions. So to begin with the basic model then, everybody knows the three components. We begin with an IS curve, the familiar inverse relationship between real output and the real interest rate. The only wrinkle here is in this formulation, the real interest rate is decomposed into two components. B, which is the central bank's overnight rate, and M, that is a markup applied by commercial banks. And in this simple formulation, that doubles as a measure of the rate spread between the bank's rate and the commercial lending rate. The Phillips curve, well, first of all, I have a generic form of the Phillips curve, which is agnostic about the precise shape of the Phillips curve. vertical or negatively sloped, whether or not there is a trade-off between nominal and real variables. If your religion insists upon it, then under some fairly familiar assumptions, that generic Phillips curve can be transformed into the accelerationist version, which is the second Phillips curve here, describing the rate of change of inflation as dependent upon the difference between the level of real output, the actual level, and a natural rate of output. Okay, thanks. And I'm actually, again, time permitting, going to use examples here of both of these Phillips curves in the argument that I'm going to make. Well, the third equation then is what the central bank does, the interest rate operating procedure, and all I'm doing here is describing the rate of change of the central bank's overnight rate as depending in the most general form on the departure of either inflation or real output or both from target values. And of course, under certain specifications of the Phillips curve, the target level of real output is going to correspond to the natural rate. So that's the basic model in a simplified form. And now what I want to do is to go on to describe, again, examples of policy working despite policy model misspecification. Okay, so example number one is a misspecified IS curve. So let's suppose that the true model involves the relationship that you see at the top of the slide here, where M is inversely related to B, so that as the policy rate goes up, for example, the markup goes down and vice versa. The behavioral intuition here is quite simple. What is happening is the commercial bank perceives that the central bank knows more about the general state of the economy. So if, for example, the central bank cuts rates, the commercial bank decides that this must be an indication that the central bank senses the economy is, well, on the downturn, that things are looking bleaker ahead, that lenders' risk is therefore increasing, and that this might be a good time to nudge up commercial rates. So this sort of behavior is certainly at least consistent with empirical observation that credit spreads tend to be counter-cyclical, at least in countries like the US. So let's suppose, this is hypothetical of course, that this is how the true model works, but nevertheless, let's suppose that the central bank treats that commercial bank markup as fixed. So what we end up then is with a true IS curve that looks like the first equation, but a policy model IS curve that looks like the second equation. This is a built-in Lucas critique problem, quite literally. The central bank is treating as parametric something that is actually endogenously varying with its own policy instrument. So a built-in Lucas critique problem. And the question then becomes, what does this do for the operation of monetary policy? Well, if we do a little bit of arithmetic, and it's after lunch and I'm going to spare you the sort of gory details, we can summarize the dynamics of this economy in terms of these two equations. And if we then look at the equilibrium of the system, just by setting the rate of change of output and of inflation to zero, what we find is that the equilibrium solution of the system is perfectly consistent with the two target values of the inflation rate and the level of output. Well, okay, that's all very well, but can we get into the equilibrium? Well, here's what's required. The first thing that you'll note here is that the standard conditions that are really required for the adjustment of policy here, and the adjustment of the economy as a whole to lead us towards the equilibrium rather than further away or just round and round in circles, do indeed depend on commercial bank behavior. That parameter eta is intervening, okay? It matters whether or not the economy will be stabilized. But what we can see is that the conditions for stability will go through as long as eta is small. The intuition here, never mind the mathematics, is what? That stability is plausible as long as the commercial bank's response to changes in the central bank's overnight rate is not too strong. Or to put it differently, as long as rate spreads are not too strongly counter-cyclical. So we might consider those conditions to be at least plausible, not entirely implausible, and consequently the conclusion is then, well, at least under certain circumstances, despite policy model misspecification, central bank policy will work, as defined earlier. So that's example number one. Example number two. This is a case of a misspecified Phillips curve. So let's suppose again that we have a true model, an actual economy that operates in line with the two equations that you see at the top of the slide here. The first is my generic Phillips curve. The second, well, that requires a little bit more explanation. Time is limited, so let me try to be brief, but at least give you some of the behavioral intuition there. What that second equation is doing is it's actually describing the expected change in inflation. This is coming from a model that I developed with a couple of colleagues in Brazil, Jason Silveira and Gilberto Lima, in which there are two populations of agents in the private sector. Credulous agents, whose inflation expectations are anchored to an announced policy target rate of inflation, and incredulous agents who don't believe in the inflation target and who just set their expectations adaptively. So that if we look in that kind of world at the expected change in the inflation rate, it ends up being a weighted average of the change in, or the expected change in inflation of those two populations. And again, kind of chugging through the arithmetic, we end up with the second equation here. So without me actually going into the details, there is a paper that accompanies this presentation, or there will be shortly. So if anybody has a nose for the details, you can certainly get your nose into the details, even though I'm glossing over them here today. So that's the true model. Now, let's suppose that the central bank fails to understand that true model, right, or fails to capture at least all of it. It instead thinks that it confronts an accelerationist Phillips curve, and at the same time that, in fact, inflation will automatically settle at its target level. What's going on there? Well, effectively, the central bank thinks that some other policy authority is looking after inflation. Perhaps, for example, there is an official indexation policy, which it thinks is sufficient. And there is a literature that suggests that this is possible, that indexation is sometimes sufficient to reduce conflicting claims over income to the extent that inflation will settle at a particular level rather than continuing to increase in the manner that is characteristic of strato-inflation. So perhaps the central bank believes that there is a strong indexation policy in play. Or alternatively, that there is an incomes policy being operated by another policy authority elsewhere in the economy. Either way, believing this to be true of the operation of the economy, the central bank is then going to adjust interest rates in accordance with this reaction function here, where it sees its job as solely being to nudge the economy back to what it takes to be the natural level of output, to avoid, of course, the nasty accelerationist consequences that it thinks would be the consequence of departing from this perceived natural rate, and that would certainly create a lot of problems for this assumed second policy authority in its pursuit of an inflation target. So what we've got here, again, by design, because these are just model or toy economies that I'm putting together, is an example of a Tinbergen problem. There is no other policy authority here. Essentially, the central bank is using one instrument in a non-vertical Phillips curve world to pursue two targets. Okay? And, well, according to the Tinbergen principle, that's just not going to happen. Okay? Except it is. Okay, so once again we can summarize the dynamics of the economy, sparing you the arithmetic. This is what we end up with. The equilibrium of this system, we look at where the rates of change of output and inflation are zero, is once again consistent with the policy targets. And what we find is that, well, again, looking at the conditions that are necessary for the economy to adjust towards that equilibrium, they do indeed depend on the wrinkle in the real economy, or one of the wrinkles at least, that the central bank is overlooking by virtue of model misspecification, namely 1 minus k, which is the percentage of credulous agents in this economy, those who actually believe in the inflation target. But what we'll find, again, just to cut to the chase and to spell out the intuition, is that stabilizing this economy, despite the apparent appearance of a Tinbergen problem, is entirely plausible as long as, well, essentially as long as we have k less than 1. Okay, that's all that we require, is that at least some decision makers remain credulous, that the target rate of inflation remains credible in the minds of at least some private decision makers. And again, I would suggest that that condition is at least plausible, so that it is not implausible to think of this economy being successfully stabilized, despite the fact that it is apparently crippled by too few instruments relative to the number of policy targets. Okay, so let's come now to the interpretation. What are we to make of these examples? First of all, let's put them into some kind of context, right? No one can argue from the specific to the general. So I'm obviously not saying here that because I can cook up a couple of simple logical examples, that I can stand and make the pronouncement that policy model specification doesn't matter, and that policy will always work whatever the specification. That's not the claim. Instead, this is more of a kind of black swan argument, in the sense that if we start with the null hypothesis that all swans are white, so in this case, that there is absolutely no tolerance for policy, there is no tolerance for model misspecification for policy. It will automatically fail if there is the slightest model misspecification. If that's the null hypothesis, these examples serve to refute that hypothesis. There are at least some cases then where policy will work despite model misspecification. But what I want to suggest is that that really is a good news, bad news story for the policymaker. It may seem, obviously, like a good news story, that essentially you can get away with model misspecification, and that model uncertainty in some sense doesn't matter. I would suggest the bad news is what's more important to emphasize here, and the bad news is a little bit more subtle, because in a sense the good news is the bad news, or at least, I think to put it more precisely, the bad news really stems from the good news. Because I think what could happen here is that policymakers can be lulled into a sense of false security. It becomes possible here to conflate the success of policy with the successful understanding of the economy. Whereas what I've just shown is that policy can succeed despite an incomplete understanding of the economy. Okay? And what I'm ultimately suggesting then is that central bankers and policy authorities in general need to be acutely aware of that possibility. Because of course the danger here is of policy model complacency, of thinking that because my policy works, well then automatically I know everything there is to know about the economy, and nobody can tell me anything different. Nobody can add to what I need to know. And that creates the vulnerability to surprises that I was talking about earlier. Nasty events that are actually systematic features of the misunderstood true model of the economy that really aren't on the central bank's radar screen. They can't be, because they're not part of the policy model. And one might think, of course, in the current context, of the 2007-2008 crisis as an example of just that. If you did, then you'd be in the company of people like Charles Goodhart and others who've argued, for example, that DSGE models in which there are no commercial banks and no possibility of default because infinitely far-sighted, omniscient representative agents are just too clever to get into that kind of trouble. Well, you know, if you misspecify the model in that fashion, you're setting yourself up for some very nasty surprises if, instead of a great moderation, what you were actually experiencing was a latent accumulation of financial fragility, which was undermining the sustainability of the growth process. So what's a policymaker? Oh, well, before I get onto that, very quickly, just without wanting to labor the obvious, both of the examples I've gone through provide examples of how these nasty surprises can come about. So in the first case, with the misspecified IS curve, it's quite possible then for eta to become too large. In other words, for rate spreads to become aggressively counter-cyclical. And if that happens, central bank policy will start to fail, even if it previously worked. And in the second case, okay, if the target rate of inflation loses all credibility, once again, a previously successful monetary policy will begin to fail for no apparent reason. That's what it's going to look like from the point of view of the central banker. And I would say it's possible to imagine real-world circumstances in which either of those circumstances could, in fact, emerge. The 07-08 crisis might be an example of the sudden aggressively counter-cyclical rate spreads. The 1970s, you know, the end of the sort of assumption, at least in the northern hemisphere, that inflation was always of the creeping 2 to 3% variety. Okay? These sorts of things have happened, and they're sort of game changers from the point of view of these parameters. So what is a policymaker to do? Well, I would suggest that the lessons for policy here are actually quite humble and quite simple, and they are encouragingly cheap, right? Economists are always looking to economize, so anything that is cheap, right? Low cost, that's got to be attractive. Well, essentially, my advice is that, again, if wholesale replacement of one model with another is not the lesson learned from the crisis, and again, maybe that is the lesson that should be learned, but if it's not learned, then the very least I think that is required here is that greater attention be paid to a greater range of macroeconomic models. Now the good news here is there is no shortage of these alternatives, right? There are lots of heterodox models that differ fundamentally from the standard 3 equation, or in its souped up form, DSGE model, that is in many respects, certainly has been the dominant policy model in policy making circles. The even better news is that these alternative models are provided free of charge by fools like me in the academy. They're given away, right? So that at the end of the day, paying attention to these things is essentially just like taking out a free insurance policy. What's not to like about free insurance? Okay? So, to wrap this up with some conclusions then. There's no lack of discontent with economic theory in the wake of the crisis, and, well, nor should there be either, in my opinion. What I've done today, though, is in many ways put forward a more modest proposal. If discontent, or at least uneasiness with theory since the crisis, doesn't lead to wholesale replacement of one set of ideas with another, it should at the very least call attention to the need for more eclectic thinking in policy circles. The bottom line here is that paying attention to the variety of heterodox models that exist acts as essentially a free insurance policy. The models are provided at no charge, and they essentially help to insure policymakers against the downside risks of what I've called nasty surprises, events that can be thrown up by what's really happening in the real economy that aren't on the policymaker's radar screen because of policy misspecifications that nevertheless, under the right conditions, will not always thwart the operation of stabilization policy. So the take-home here, since I've got 2 minutes left, if you were to put this in 2 sentences, there is such a thing as a free lunch, because these heterodox models are there and given away free of charge. So really all I'm saying is act like economists confronted with a free lunch and eat up. Thanks very much.
Agradecemos a los